Hello everyone and welcome to BDO's webinar on the proposals for US tax reform. Today's webcast is part of a series of webinars hosted by BDO International, where we take a deep dive into global trending tax topics. My name is Malcolm Joy. I'm an international tax partner based in the London office of BDO in the UK, and I'm very pleased to be joined by three colleagues in the US. We have Joe Caliano, who is a partner and technical practice leader in our international tax team in the US. We also have Todd Simmons, who is the national managing partner for our tax risk management practice in the US. And thirdly, we have Scott Smith, who is the technical practice leader for state and local taxes at BDO in the US. Before I get started, I'd just like to take a moment to go through support information with you and highlight some of the features of the webinar today. All attendees of this webinar are in listen-only mode, which means that you should be able to hear the webcast through the speakers in your laptop if you have good broadband speed. If, however, you are experiencing any difficulties with the audio quality, then you can use the teleconferencing facilities and dial into the webcast. Details are contained on the Event Info tab on the top left-hand side of the screen. If you have any questions on the content for the webinar, then you can submit the questions at any time throughout the webinar using the Q&A and chat functions, which are displayed in the bottom right corner of the screen. And if time permits, at the end of the webinar, we will have a look at those questions and answer the questions for you. If you could submit your questions to all panelists, then we may respond verbally throughout the webinar or after the webinar. The slides from today's webinar will be made available after the presentation, and they will be emailed to you along with a link to a recording of today's broadcast. And previous webinars are also available on the BDO International channel on YouTube. For those of you who are in the US and would like to receive CPE credits for today's webinar, then you will need to actively participate throughout the webinar by answering at least 75% of the pop-up polling questions that will appear on the screen. BDO US will then be issuing certificates after the webinar. So without any further delay, let's get started on the webinar. I think I'll start by saying I've never known a time when there has been more interest in both US politics and US tax reform than at present. And today's webinar has proved exceptionally popular, in fact more popular than any other webinar that we have ever hosted. And approximately 2/3 of the audience for today's webinar are based outside the US. So we will be endeavoring throughout the webinar to keep the content at a level where it is accessible to us non-US folk. The agenda for today's webinar is as follows. First of all, we will start with Todd outlining the domestic priorities for President Trump and the Republican Party. He'll also talk us through the process for bringing about change in the US. Joe will then take a look at the corporate tax proposals and explain how they could affect international businesses. Scott will then talk us through the state and local tax implications, again with a focus on international businesses. And then to end the webinar, we'll go back to Todd to consider tax risk management issues and concerns in light of the proposals. So first of all, Todd, if I could hand over to you.
Thanks, Malcolm. Thank you, everyone, for joining today. When President Trump ran during his campaign, there were several issues and several campaign topics that were very important to him. Three of them of note would be health care, and there's tax reform, and, of course, immigration. Since his legislative priority of health care sort of failed last week, it which was supposed to really pave the way for tax reform, both domestic and international. The future of tax reform is a little bit uncertain now. It's uncertain for a few reasons. First of all, the momentum that the President had going into tax reform, because of last week's failure of health care, that sort of diminished quite a bit. Also, there's several different factions, different groups within the Republican Party, and that does make things difficult. As we saw with health care, you've got folks across the Republican spectrum that were not in line and were not in sync on what a package should look like. And that's also part of why health care didn't pass the House. And now with tax reform, the process is a little bit different. With health care, we understood the President's priority was to repeal and replace Obamacare, the Affordable Care Act. Tax reform is a little bit more complex. You've got interest groups. You've got a wide range of policy goals that want to be achieved through legislation. And so now what we've got is sort of a storm here where because health care didn't go through, and with looking for what the President wants out of tax reform, it's going to be very unclear what the path will be. We know from statements and just simply watching the news that it is a priority to start to try to steamroll this through, but we have to watch and see. It will be very interesting to see what, if anything, the President's able to do in the short term and this year on tax reform. We'll start with the President's priorities. These are some of the different tax priorities that were announced during his campaign, and we'll touch on a few of them. And as we talk about them, start to pay attention to where there is similarities both with the President and the Republican Party's proposals. And also we'll talk about where the House and Senate might be the same and the Republicans and Democrats might be the same in tax reform. The President would lower the corporate rate to 15% from its current 35% for C corporations, be a huge decrease. There'd be a 15% rate for income from pass-throughs and sole proprietors reporting on Form 1040. Right now, when they report, they're subject to the rates on the taxpayer or the entity that may be a partner or corporation shareholder. Right now, this would be capped at 15%. For individuals, the President would consolidate the current rates, and there are several of them, as you can see on the slide, to just three, 12, 25, and a top rate of 33%. He would eliminate the 3.8% surtax on capital gains investment income for higher income folks. He'd repeal the estate tax, which, if you recall, was done back in 2001. But, of course, with the 10-year sunset of that legislation, the estate tax came back. He would also eliminate the alternative minimum tax for individuals. And the President has made it clear he would cut the IRS's budget, and I think the latest word is about 14%, to help offset a $54 billion increase in defense funding. And I can tell you that the IRS really is going to be challenged by any cuts. They have experienced a lot of late, and this will make their job a little bit more challenging as they struggle with enforcement, struggle with headcount, and customer service. And also identity theft is another issue they're dealing with as well, and any cuts in funding will clearly impact their programming. The Republicans back in June of last year had come out with what's called the blueprint. We'll talk about some of their domestic priorities. The blueprint is the House of Representatives Republican Party's vision of tax reform. Looking at businesses, the Republicans would lower the corporate rate to 20%. So we see already there is agreement to lower that corporate rate. And I'll tell you also, on the Senate side and with the Democratic Party, there has also been interest in lowering that rate, perhaps not as low as 20% or 15%, but there is interest in 24%, 25%. So that is a place where there might be agreement. The Republicans would eliminate some of the special interest deductions and credits, and they use an example of Section 199. They would repeal the corporate alternative minimum tax. They would allow net operating losses to be carried forward indefinitely. There would be no carryback with adjustments for inflation. Carry forwards would be limited to 90% of net taxable income for the year. They would allow businesses to immediately write off the full cost of new investments, both tangible and intangible, in the first year. And they would only allow interest expense to be deducted to the extent of interest income. Remaining net interest expense will be carried forward indefinitely to offset future net interest income. They'd provide a business credit to encourage research and development. Okay. They would preserve the last-in, first-out method of inventory accounting, and they'd eliminate many other credits and deductions to offset the cost of what their legislation would be. For individuals, they would consolidate the rates as well to 12, 25, and 33%, just as Donald Trump has proposed during his campaign. Pass-throughs and sole proprietorship income would be taxed at 25%. President Trump was at 15%. They would allow a deduction for half of net capital gains, dividends, and interest, which would effectively lower the rate on that type of income to half of the consolidated rates above. They would remove the 3.8% surtax, as would the president. They would repeal the alternative minimum tax as well. They'd eliminate many deductions, credits, et cetera, to pay for some of these changes. And the Republicans would also repeal the estate, gift, and generation skipping transfer taxes, all of what's known as Subtitle B of the Internal Revenue Code. So how does legislation get changed? Well, we talked about in the beginning, first of all, there has to be an interest in doing so. When the president campaigned, again, one of his big priorities was tax reform and tax decreases. It isn't as simple as that. You need support, and you need support from certainly your party, as well as both the House and Senate. When you have a large majority in your party, it makes life much easier. When, however, the majority is pretty thin, which it is in the Senate in particular, it becomes a little more challenging. Now, all bills for raising revenue, which would be tax legislation, start in the House of Representatives. Our federal Constitution requires that. The Senate, though, may propose or concur with amendments, and they oftentimes, I can't remember a time when they wouldn't, for major legislation, come up with their own bill. Okay. Now, tax legislation originates in the House, and the House must take that action before it moves on to the Senate, formally speaking. Individual members of the House or Senate can prepare a proposed law or a bill. Okay. The House Committee on Ways and Means and the Senate Committee on Finance are each responsible within their separate houses for considering tax legislation. What they do then is mark up proposals. So when you hear that the House Ways and Means Committee or the Senate Finance Committee is marking up a proposal, they are considering tax legislation to be formally adopted by the committee, approved by the committee, to move on to the full House or the full Senate. Staff from the Congressional Joint Committee on Taxation and the U.S. Treasury Department generally assist in analyzing policy changes. The Joint Committee on Taxation is actually the official scorekeeper. They are the official numbers, folks, what legislation would cost to enact or what revenue it would raise to enact. Legislation counsel from both the House and Senate will assist in drafting bill language. It is sort of a form of art, and so those folks are trained and educated in how to write legislative language. The Ways and Means and Finance staff will generally prepare committee reports, which will describe bills that are marked up by either committee. The Joint Committee on Taxation will prepare what's called a blue book, which is an explanation of any legislation that is actually enacted. Usually the Joint Committee will prepare this, and they'll do so around December or so for any legislation that is enacted during the tax year. Now, what happens when the House and Senate don't agree on a piece of legislation? And that is usually the case. And they talked about it during the health care discussions of the past few weeks as well. If it did pass the House, then it would go to the Senate, and the two would come together in what's called a conference committee. That is a committee that is appointed by the leadership of both House and Senate to work out their differences, to reconcile the differences in legislation between both. And it's no different for tax bills as well. Conference committee would come together, and they would have to agree on changes. So they would take the House's and the Senate's provisions, come up with one package, and then that would be the package that both the House and Senate would then consider, again, in passing, because only one bill can then go to the President for consideration, whether it's signed or not, or vetoed. And the conference committee will prepare a report. That report, I think many folks feel, is the best legislative history you can get for a piece of enacted legislation. It is the most contemporaneous. It is really the thoughts at the time that the House and Senate come together and make their one bill. And then again, it is sent off to the President for signature. On that note, Malcolm.
Thanks for that, Todd. It's interesting hearing about the process you need to go through in the U.S. to change the tax system. What's the most likely time frame for that change happening? How long will it take to go through all that process, do you think?
Well, you know, Malcolm, if you had asked me 3 or 4 weeks ago, I probably would have had a different answer than I have now. Right now, and it all goes back to healthcare failing last week, and then really just both the House and the White House setting it aside. there's really word that they're really trying to ramp up tax reform now. If you remember back when the second President Bush came in, we had a bill in May, I think, of his first year. It was ready. It was enacted in June. Now it looks like we might be on a faster track than we thought. A couple weeks ago, people were thinking it might not even be 2017. But I think that there is interest in getting something done now just to keep the momentum, to try to keep whatever momentum there might be. So it wouldn't surprise me to see some real discussion very soon.
Okay, thanks. And actually, just to let everyone know, we've just put the first polling question up on the screen there, so if you want to answer that, I'll just ask another question or two to Todd. Clearly the pushback that President Trump's had on the changes to the Healthcare Act have highlighted the fact that it is quite challenging to get everything through in the way he wants. Do you think it's likely that we will see a lot of compromise on these proposals and a lot of renegotiation of them and maybe coming up with some kind of watered-down proposals for reform of the tax system?
Well, I think, first of all, I think the latest is that there's a willingness to work with the Democrats, but you almost have to, Malcolm, because the cost of not working with them, and this is what happened back in 2001, is that to get tax legislation through, you oftentimes will have to do it through what's called reconciliation, which will likely lead to a 10-year sunset. So after 10 years, the tax legislation sort of sunsets, and that's what happened to the 2001 bill. And that's not great policy. In order to get it to be a cleaner tax bill, you will need some buy-in, particularly in the Senate. When you don't have a supermajority in the Senate, which would be 60 or more, you have to get Democratic buy-in. They can filibuster. They can, if it is through reconciliation, which protects from filibuster, you risk that 10-year sunset. So there needs to be. And I would think that perhaps lessons were learned over the last couple weeks, that it may be a good idea to bring some Democrats into the discussion rather than steamroll through legislation. The last remark is what I started to say earlier. There is agreement between the House and Senate and Democrats and Republicans on many of the policy principles that the President and the Republican blueprint put forth. For example, lowering the corporate tax rate. That's one area where they agree. And there are other areas where they also agree. So it would really behoove them to come together for a host of reasons to try to come up with a package.
Okay, that's fascinating. Thank you very much for that, Todd. I think we'll move on now to Joe, who will talk us through the international implications of the reform of the federal corporate tax system.
Thank you, Malcolm. And before going into some of the details of the reform that's being proposed in the blueprint, it's worth discussing some of the issues that are identified in the blueprint for the reason for reform in the international front. The blueprint identifies a number of issues with our current tax system. So if you look at the United States, it has one of the highest statutory rates in the world. Compare that with a lot of other jurisdictions, especially the European jurisdictions. The statutory rate is much higher than any other jurisdiction out there. And that's led to a lot of high-profile inversions. Many of you are familiar with that, where you had U.S.-based companies becoming foreign-based companies in various transactions. So it's led to inversions. Now, some other things that it's led to is the lockout effect. And that's where you have, and the blueprint identifies this as $2 trillion of earnings overseas. So what you have is U.S. companies that aren't bringing the money back from their foreign subsidiaries in the form of dividends. Now, to some degree, that may be because they're deploying the money abroad, but in many instances, it might be they're not bringing it back because of the high statutory rate and the cost of bringing it back. Which leads to the next point, which is we have a worldwide tax system. Many of you who are in European countries are very familiar with the territorial tax system. The United States has a slightly different version. We have a worldwide tax system. So we tax income wherever earned. So if you have a foreign subsidiary that earns income abroad and it's distributed in the form of a dividend, that's generally taxed in the United States. the primary mechanism that's used to kind of offset that income is the tax on that income is the foreign tax credit. Now, there could be other tax attributes that are used, but the foreign tax credit is the primary mechanism for offsetting the earnings that are brought back offshore. Now, you have a lot of U.S. companies that own subsidiaries in low-tax jurisdictions where bringing that back, the dividends might bring little or no foreign tax credits with it. So there's somewhat of a disincentive for bringing money back into the United States. And as I mentioned, most of our trading partners, the blueprint outlines, most of our trading partners have territorial systems. So with the high statutory rate, the increase in number of inversions over the years, the comparison of the worldwide tax system to the territorial system, there's been a decision, or the House Blueprint has proposed changing how we fundamentally tax U.S.-based companies. And this is most of what I'm going to talk about in the next couple slides we've seen to some degree in past proposals, like the CAM proposal. The border adjustments, which we're going to get to, is a slightly more controversial area, and we'll discuss that in a little bit. So let's go to what the proposal, the blueprint, actually proposes to do. So and the goal here is to make the U.S. more competitive on the global stage. What do they do what's the mechanism for doing that? First, lowering the corporate tax rate to 20%. Secondly, switching from a worldwide tax system to a territorial system and scaling back our Subpart F rules. And if anyone's ever dealt with our Subpart F rules, they're incredibly complex. I deal with these on a pretty regular basis, and you know, there's thousands of pages of regs dealing with this. So they're quite complex, and that's one of the things that the blueprint proposes to do, is to scale back those, move to a territorial system, and implement border adjuststants.
And Joe,
yeah.
Sorry, just for the benefit of the overseas attendees who are listening in, Subpart F rules are the equivalent to the controlled foreign company rules?
Yeah, these are our CFC rules. These are the rules where a CFC, a foreign subsidiary of a U.S. company, if it's a controlled foreign subsidiary of a U.S. company, if it earns certain types of income, even though it's not being repatriated in the form of a dividend back to the U.S. company, it can be taxed in the United States. And it's commonly referred to as our Subpart F rules, but they're basically anti-deferral rules that are designed to tax income in certain foreign subsidiaries that's earned offshore, certain types of income, even if it's not repatriated. And they are a very complex set of rules. If any of you have ever dealt with it, you'll know when I say they're complex, you'll know what I'm talking about. So let's go to our next topic, which is probably the most controversial topic, at least on the international side and perhaps in the whole tax reform realm. It's border adjustments. And what we know from the border adjustments really is what's in the blueprint. We haven't received a lot of details, and obviously the devils always are in the details as to how they operate it, how they'll operate. But let's go through what it's designed to do, at least as discussed in the GOP blueprint. It's a destination-based approach. The tax jurisdiction of the income follows the location of consumption rather than the location of production. And here, based upon the blueprint, it essentially would exempt exports from U.S. tax while taxing imports. And the way to describe it in the blueprint is products, services, and intangibles that are exported outside the United States will not be subject to U.S. tax, regardless of where they're produced, and products, services, and intangibles that are imported into the United States will be subject to U.S. tax, regardless of where they are produced. And here it's, you know, once again, there's not a lot of details on this. Now, does the last bullet point I just read dealing with imports mean that if you're a net importer, you won't get a basis in the goods that you bought if you're going to unsell them, or you don't get a deduction associated with that? And that very well could be the case. We're still, you know, obviously waiting on details to emerge on exactly how it would operate. But it could. There's been a lot of discussion here in the United States with respect to these border adjustments. Certain industries, like the retail industry, has been very vocal about the potential impact on it, because if you have the retail industry that's purchasing from abroad and then selling here in the United States, if it loses, let's say, the cost of goods sold on the items it's acquiring when it sells it to a third company or to a consumer, that could have a dramatic impact. Now, with border adjustments, there can be winners and losers, and it depends on the industry and the company. If you're a net exporter, this could be a really good thing for you. If you're a net importer, it could be a not so good thing. And as I mentioned, how they will operate, like will the border adjustments as it relates to import mean that if a U.S. company buys something from abroad and then on-sells it, it doesn't get a cost of goods sold or a deduction for what it purchased? The details on that will remain to be seen. Will the foreign person be taxed? Those are the kinds of details that will need to come forward if this moves forward. The goal here of border adjustments is to eliminate the incentives to remove or locate operations outside the United States while allowing U.S. products, services, and intangibles to compete on a more equal footing in both the U.S. market and the global market. Now, there's been an issue that's been raised about whether as proposed in the GOP blueprint, whether these border adjustments pass WTO, whether they're WTO compliant. And just to give a little background on that, generally, you know, with border adjustments, they're generally okay under WTO if it's an indirect tax, and generally VATs are okay under the WTO. However, a border adjustable direct tax generally is a prohibited export subsidy. So when you look at the blueprint, they don't call these border adjustments a VAT. It's not called an indirect tax. Now, query whether it functions like one. You can see from the bullet I have here, the GOP blueprint believes that what they're proposing here would be WTO compliant. Now, you know, there's been a lot of discussion in the tax press about whether it would or would not be WTO compliant, so that certainly is an issue that will be monitored if border adjustments move forward. Now, you know, the White House, the Treasury Secretary, there's been some news reports on some statements that the Treasury Secretary has made suggesting that in their current form they might not quite be getting the full support of the White House in their current form. So there's a lot to come on border adjustments if it moves forward. Once again, as I mentioned, we don't have the full amount of details on the operation of this, just some broad sweeping statements in the GOP blueprint. So if these move forward, obviously, there would need to be more details on exactly how they would operate. How does it operate for services, for manufacturers? But one could look at this, though, and say, if you're a net exporter and this moves forward, you're probably in a better position than if you're a net importer and it moves forward.
Thanks, Joe. Just before you move on to the territorial regime proposals, just to let everyone know the second polling question is up and running. You've still got just a couple of minutes left to answer that one. Thanks, Joe.
Okay. Malcolm, this seems to be the one that has gotten the focus of a lot of companies here in the United States and a lot of industries. And Malcolm, I'll ask you a question. Has this been a point of a lot of discussion abroad in Europe?
The border adjustment, Joe, we're still talking about, or the move to the territorial border adjustment? Yeah, it has. And I've been speaking, certainly a number of my UK-based clients are quite fearful of it. There's a number of large retailers who export a lot of product to the US who are busy calculating the impact for them, and I think it's going to cost them quite a lot of money. And there's certainly a lot of interest from everyone I've been speaking to about just how feasible it will be for the U.S. to implement these changes. Yeah,
and that's the question. I mean, how will it operate? Will it, if it's a foreign person selling to a U.S. retailer here who's going to on-sell, will the U.S. retailer not get the benefit of the cost of what it purchased when it on-sells? Will the foreign person be somehow taxed on a sale which kind of raises also tax treaty issues as well. So there's a lot of issues surrounding border adjustments, and it seems to be the hot button issue in talking about tax reform, at least on the international front. So maybe we can move on to a switch from a worldwide tax system to a territorial regime. This has been proposed several times. CAMP proposal and several others have made this proposal to switch from a worldwide system and go to a territorial system. Now, under this proposal, it would replace the current worldwide taxing system and allow 100% exemption for dividends from foreign subsidiaries. Now, whenever you switch from one type of system to another, the question is, how do you deal with all those earnings offshore that haven't been taxed in the United States? And most of the proposals I've seen, including the blueprint, have a transition rule for earnings that have accumulated overseas under the old system, the worldwide tax system. And under this proposal, accumulated foreign earnings will be subject to tax at an 8.75% to the extent held in cash or cash equivalents, and otherwise will be subject to a tax at 3.5%. With companies being able to pay the resulting tax liability over an 8-year period. That has been that proposal there has been in some other tax reform proposals, prior ones. Here, the goal is once again to move the lockout effect. The goal here is really to have U.S. companies bring the cash back from their foreign subsidiaries, those earnings back from their foreign subsidiaries. And the belief is that if you move to a territorial system, there'll be an incentive to do that, especially here if you have 100% exemption for dividends from foreign subsidiaries. Now, the Subpart F rules, they will be scaled back considerably under this proposal. They would be only the foreign personal holding company rules, which are designed to counter the potential for truly passive income to be shifted to low tax jurisdictions, will continue to play a role in addressing potential abuse. So what you see here, once again, is lowering the corporate tax rate, moving to a territorial system, scaling back the Subpart F rules, and border adjustments being with essentially the mechanism to reform on the international side the tax system and to achieve some of the goals of reducing the number of companies that are looking at it inverting, where any of you have followed inversions, the IRS and Treasury has put out a slew of regulations to address them. I think the thought here is if you make this a more competitive tax system, there'll be less incentive to invert, more of an incentive to bring money back to the United States, and that the economy and will grow as a result of this, and it'll end the lockout effect. And let's see, I know we have a polling question here, Malcolm.
Yeah, so I was just going to get the next polling question running, and whilst that's running, if I could just ask a couple of questions, Joe. A lot of controversial change, I think, there, particularly the border tax, the border adjustment. Which of those do you think is the most controversial, and do you think it's likely that all of those changes will go through, or are we likely to see a number of those proposals go through?
Well, I think Todd brought this up, and I'll reiterate. I think we've seen in most of the proposals that have been out there, aside from the blueprint, to reduce the corporate tax rate. So that I don't think is that controversial. Now, what number that comes in at, 15%, 20%, 25%, that could be a point of debate. Moving to a territorial system, as I mentioned, this is not the first time we've seen, this is not the first proposal by any stretch of the imagination that we've seen to move from a worldwide tax system to a territorial system. Most of the European countries have adopted some form of territoriality. So that I don't think is that controversial, although there are some people who may not want to move to that. I think that's been out there for a long time. The border adjustments, I think, is the item that is most controversial. Obviously, certain industries may benefit from border adjustments the way it's at least preliminarily described here, and some industries will be hurt. There's been a good amount of lobbying by certain industries that feel that they would be very negatively impacted by it, and I think that that's likely will be something that will be debated for a while, and it's not clear whether that will move forward. I know there's a certain lukewarm reception to that by some people in Congress. Certainly you have industries and certain U.S. companies that will be lobbying hard not to have that in tax reform going forward. So I think that's probably the one that we're likely to see the greatest amount of debate on, and will continue to.
Okay, thanks. And it strikes me that there's many other countries that are implementing some kind of tax reform at the moment. But the majority of countries that are doing so are really doing so on the back of the BEPS proposals that the OECD came out with following the request by the G20 to look at the international tax system. I'm just intrigued as to what extent the BEPS proposals are on the agenda in the US, or is this, are these proposals largely separate from anything that the OECD looked at under the guise of BEPS?
Well, the U.S. was an active participant in BEPS. I mean, they were actually one of the driving forces at the table when it comes to BEPS, the Treasury. But when I look at the proposals we're seeing here from at least the GOP blueprint, I see these more as an attempt to try to make the U.S. more competitive in the global marketplace, because I think that this proposal, along with other ones that preceded, there's a general consensus that the U.S. is not on equal footing when it comes to, from a competitive standpoint, than many of their common trading partners, many of the countries over in Europe, because of the high statutory rate, the worldwide tax system. So I see this as really a transformation of how the U.S. is looking at their system and saying, how can the U.S. be more competitive on the global landscape? So I see that more as the driving force with respect, certainly on the international side, because I think there's been a lot of complaints that, the U.S. just isn't very competitive when it comes from a tax standpoint. And I think this proposal, along with predecessors, really are designed to kind of put them more in line with other countries, their trading partners. And I think that's the motivating force here, more than anything else.
Thanks, John. I guess just thinking about it, one of the main areas of focus for the BEPS proposals was the alignment of the profits of a multinational with the economic substance. And if the U.S. has got a very high tax rate that discourages groups from having much substance in the U.S., then I guess there is likely to be a knock-on effect of reducing the corporate tax rate, and that the multinationals are much more likely to bring the substance back to the U.S. So I guess there's a link there between the BEPS proposals and what the new administration is looking at.
Yeah, well, when you think about this, Malcolm, I mean, today, how many people are thinking, I want to set up my IP holding company in the United States, if given a choice?
Yeah, it's not a question that's asked very often, is it?
Yeah, no. I mean, usually the discussion is centered around U.S.-based multinationals who are moving IP offshore into lower tax jurisdictions that are much more favorable. And I think there's a recognition of that, and a recognition that our high corporate rate combined with some of the items I talked about make the U.S., it's almost a disincentive to be, everyone generally needs to do business in the United States because of the economy we have here. We're a big consumer, but you won't hear discussions, well, what place are you looking for your IP holding company? Certain countries come up. The United States generally is not one of them.
Okay. Well, thanks for that, Joe. Very, very interesting. One of the other unusual features of the U.S. tax system and U.S. government generally is that on top of the federal tax, of course, we have a whole host of state and local taxes. And Scott is now going to talk us through the impact of some of the proposals on the state and local taxes.
Thank you, Malcolm. And I think first it might be helpful, especially for our attendees from outside the United States, to give a little bit of background of the state corporation income tax system and why federal tax reform also matters for state income taxes. And it's because of a sort of trickle-down effect. Any federal tax reform will also have some impact on state income taxes. You know, like the federal government, there are 50 U.S. state taxing jurisdictions, 51 if you include the District of Columbia, where the federal government sits. And of these states, 45 states, including the District of Columbia, do have a corporation income tax. And each of these states conform to a greater or lesser degree with the federal tax code, which we call the Internal Revenue Code. And as a general rule, federal taxable income, you know, however it is determined for federal income tax purposes, will flow through for purposes of a state corporate income tax return and essentially be the starting point for determining what is a U.S. company's or a non-U.S. company's state taxable income. And then the states may further adjust that federal income tax starting point. For example, they may require certain federal deductions to be added back to taxable income, or they may also permit certain items of income that were included in federal taxable income to be subtracted in arriving at the state taxable income base. Now, as Joe mentioned, as part of federal tax reform, one aspect is a possible move to a territorial taxing system. States, a federal move away from worldwide taxation to a territorial system. The states would probably tell you that they neither follow a territorial nor a worldwide system, but there are certain unique departures from the federal tax code that have international ramifications, and the probably most important being states do not follow a federal tax credit type of tax relief with respect to taxation of worldwide income. Rather, states will apportion income using a certain type of formula. Most states are moving towards sales factor only apportionment formulas and away from a three-factor formula consisting of property, payroll, and sales. But some of these unique state departures can result in non-U.S. companies either being directly subject to state income tax or their income being included in the measure of a state's income tax. And then on top of all of this, as a general rule, U.S. tax treaties do not apply to states, with the exception of the non-discrimination article. So there can be situations where a non-U.S. company is subject to income tax in a U.S. state when it may not be subject to the federal income tax. So how do states figure out that federal income tax or that federal taxable income starting point? How do they conform to the Internal Revenue Code, in other words? Generally, there are three types of states or state types of conformity to the Internal Revenue Code. The first is what we call rolling conformity, and these are states that will almost automatically pick up any federal tax changes. So they may enact special legislation to opt out of certain federal tax provisions, but I'd say estimate about 15 to 20 states are rolling conformity states. They will conform to the Internal Revenue Code as amended. So when the federal government changes the Internal Revenue Code, these states will automatically pick up that change unless they specifically opt out. Another group of states are what I characterize as fixed date conformity states. These states will conform to the Federal Internal Revenue Code only as of a specific date. For example, a state may conform to the Internal Revenue Code as in effect on December 31, 2016. So any federal tax changes that occur after December 31, 2016, that state is not going to automatically pick those up. It would need to either enact new legislation, updating its conformity date, or specifically adopt those provisions. Now, there are a number of states that have no incorporated reference date to the Internal Revenue Code and simply use federal taxable income as their starting point, but again, have no specific date that we would look to determine, well, which version of the Internal Revenue Code is used to define the state's federal taxable income starting point. And then there are a few other states, California being the major one of states that only conforms to specific Internal Revenue Code sections. But with that, and
Scott, let's advance the slides, if you would, just to where you are presently.
Yeah, this is, I mean, Malcolm, my slides are not, they're not advanced. Here we go. I'm sorry. Now let's assume that there is some federal tax reform this year or next year. And what can we expect with the states? Well, I think we can start with some current examples where states do not conform, and that can give us some idea of how the states will respond to federal tax reform. For example, a number of years ago, for federal purposes, the Congress enacted the bonus depreciation, Section 179 expensing, the Section 199 domestic production activities deduction. These are some examples of federal tax deductions where a number of states have either limited or refused to conform to these federal provisions. In addition, a number of states do not conform with the federal consolidated return regulations. They don't conform with the period of time in which a net operating loss can be carried forward. A number of states do not allow net operating losses to be carried back. So these sorts of tax expenditures, if you will, I think suggest that the states are unlikely to conform to either the blueprints or the President Trump's campaign proposals of full expensing of capital expenditures, because for states who do have to have balanced budgets pursuant to their state constitutions, they will pay special attention to new or expanded federal tax deductions, and oftentimes will at least limit those deductions or refuse to conform to them in their entirety. Some of the other considerations I think that we should keep in mind, if federal tax reform comes to fruition, with the reduction of the federal corporate rate, we don't expect the states to also reduce their state corporate rates. They're already probably range, again, depending on the state, a state statutory corporate rate is going to range somewhere from 5 to 10%, maybe a little bit above that, maybe a little bit below that for some states. For state tax purposes, it's always the effective rate that's most important. so the rate of tax after application of the apportionment formula. But this will increase the materiality of the state income tax provision, in proportion to the total U.S. domestic rate. We do expect, to the extent that federal tax reform broadens the base, so to speak, by eliminating certain deductions, especially the federal interest expense deduction, we do expect states to go along with the base broadening measures of federal tax reform, but not so much any additional tax deductions. The Republican blueprint does allow, subject to a 90% limitation, an indefinite carry forward of net operating losses. States already impose shorter NOL carry forward provisions, so we don't anticipate that many states would adopt the indefinite carry forward of NOLs. And especially when taking into account this movement to a territorial regime, and especially a destination-based cash flow system, one question or one potential reaction from states could be, we may start seeing more states depart from a corporate income tax in favor of a gross receipts tax type of system. We have seen some states, Ohio in recent years, abandon its corporate income tax in favor of a gross receipts system. The state of Washington, Texas are two other important states that do not impose a corporate income tax but impose a gross receipts type of tax. And so federal tax reform, especially the destination-based cash flow system, could encourage more states to depart from their corporate income tax systems to a gross receipts system. Now, with regard to, sorry here, I just got hit with a polling question.
Yeah, we just got the final polling question just a bit on that. And Scott, maybe if you could, I think we've just got one slide left, and just want to leave a few minutes at the end there to come back to Todd on tax risk management as well.
Yeah, again, I think two takeaways with regard to a move to a territorial system for states. There are those states that have a form of a territorial system, the so-called water's edge unitary states. However, they're not fully territorial because non-U.S. companies can be included in those groups, so there will be a question whether those types of systems continue on the state level. And then the manner in which a border adjustment is effected will be important, I think, for state tax purposes. If it is a denial of a deduction for imports, there could be some state constitutional considerations that I won't go into that could come into play. If it's affected by exempting exports, the exclusion of gross receipts will also, from federal taxable income, will also exclude them from the state sales factor. So at least for U.S. exporters, this could have actually a tax cost, a state tax cost for U.S. exporters. If this border adjustment is effected through some form of federal tax credit, that will not automatically flow through to a state tax return, and so it may not result in a state tax benefit. As with on the federal level, there will be winning states and losing states, depending on on how that border adjustment is affected. And again, will this have some influence on states departing from the corporate income tax in favor of a gross receipts tax or some other indirect tax regime is, I think, something else to be on the lookout for.
Okay. Thanks, John. I guess the main message coming out of that, particularly for non-U.S. businesses that have activities in the U.S., is not to simply assume that any changes to the federal system will be replicated at a state level, and to make sure that they get good input on the state and local tax consequences as well. So move on to our final session now, and just to remind you, if you haven't already answered the polling question, there is still a couple of minutes left for that final polling question. But the final session, we're moving on to look at tax risk management, and it's back over to Todd for this.
Thanks, Malcolm. So we've been talking a lot today about change, and change yields uncertainty, and uncertainty leads to risk. And in any year when we have a new president, new administration, there's a lot of uncertainty and a lot of risk that goes with it. Uncertainty in making the decisions that impact tax, and all the components that go behind tax when we're talking about possible changes in the tax law. Tax risk management matters in just about every component of a business: planning, transactions, your operations, of course, tax compliance, ethics and conduct, just being a good corporate citizen. These are all components of tax risk management. We want to do what we can to try to minimize tax risk. We try to limit our disputes with the tax authorities. Now, it is unclear what the President has in mind for the Internal Revenue Service, both with respect to funding and enforcement and service. You want to make sure tax has a seat at the table for major decisions, business decisions, especially when there's legislative uncertainty. You want to make sure that you are considering the possible impact of legislative changes. You want to assess your tax risk, and you want to adhere to good compliance practices with respect to tax risk. Now, how do uncertainties impact the outcome of a transaction? Sometimes you know, sometimes you don't. Sometimes you're going to have to sort of plan scenarios. What if we go here? What if legislation goes there? You may have to take these things into account when you are planning. And as I mentioned before, even when you begin to see, say, the House of Representatives come out with changes, they may not look the same when they get out of a conference committee with the Senate. They may be different. Rates may change, the policy may change, or they may be dropped. So we've got to wait till that legislation is enacted before we can really hang our hat on it. Talk to outside advisors, of course. We follow changes regularly in real time, and certainly the impact of changes. And document your business purpose and your economic substance. When you're doing transactional planning, one huge issue here in the United States, of course, is making sure that we have good non-tax reasons for doing things that are well documented. Tax authorities are very interested in that, making sure that your planning has non-tax reasons behind it. And on that note, Malcolm, I will turn it back to you.
Okay, Todd, that's great. There's some really good practical advice in all of that. I think we're seeing an awful lot more disclosure these days to tax authorities and others on what's happening with corporate tax affairs. So making sure that you properly follow through on the paperwork is extremely important. We said we might answer some questions at the end. We have actually had a number of questions which we've been answering through the chat function as we've been going through, and we have run up against the end of our allotted time. So it just remains for me to say thank you very much to my three fellow presenters from the US, Todd, Joe, and Scott. And thank you very much everyone for dialing into this webinar. The next webinar in our series is on the 27th of June, so I look forward to welcoming everyone back then. Thank you.